Hey folks, hope you're well and welcome back to the Risk Management Education series. So far in the series we've looked at the numbers around risk, where risk management fits in both our edge itself and in building that edge, and how to build a risk management plan for execution, including some of the common elements you might want to consider within that plan. If you've not watched those videos, I would recommend you go back and watch them first, and I'll link them on the screen now. Over the next few sessions then, starting with today, we're going to start looking at the tools and processes that we've got at our disposal to implement the plan once we've got it created. We'll start with the stop loss. It seems like the best place to start. So the goals for the session today then are to understand what a stop loss is and how you should identify where to put them. This is something that's often misunderstood, particularly in newer traders. So we'll look at the mechanics of a stop, what it's actually for, and try and simplify that down into a single statement that makes it easy for you to apply consistently. We'll look at how they fit into your risk management plan, i.e. how you actually use them to implement that plan and how the two fit together. We'll look at how not to use them, which is equally as important as understanding how to use them, and it's something that I've seen quite a bit, some interesting uses of stops. So we'll cover a few kind of common misuses of stop losses, just for awareness and hopefully to make you think about whether it's something that you do or not, and if it is something that you do, should you continue with that, and at least if you do decide to continue with it, it comes maybe from a place of making that conscious choice based on the information. And then finally we'll have a look at how and when to move them, which is another kind of misunderstood part of the stop loss process, is when we can move the stops and how we should move the stops. So we'll have a look at that just to cover that off. The first thing we'll look at then is what a stop loss actually is. And I think the simplest way to think about a stop loss is that it's your insurance against unexpected loss in each individual trade. And the key word in that is unexpected. I've covered in these sessions already that losing is part of trading. It's something you need to accept when you're building systems, that you're not going to win every trade, you're going to suffer losses. So the key when we know that that's the case and we're going to suffer losses is to make those losses expected, in the sense of we know how much to expect that we're going to lose of our account or of our capital on the occasions when we lose. So it's controlled, essentially. There's no unexpected loss where it runs away from you. Now we can talk about when stops get skipped, and we'll talk about that later in the session, but for the purposes of this statement, just assume that your stop always gets filled. And it allows you to plan over a series of trades, your winners and your losers, how much you're gonna lose, if you know how many roughly you should lose within a series as part of your testing. It's a way of controlling that loss. So it's the main tool really that we've got at our disposal within any individual trade to control those losses or those loss levels. And it's also the main tool that we've got for protecting our account capital consistently across a series of trades. So there's two parts there. There's the controlling your loss in the individual trading, and there's making your loss consistent across the series of trades. And remember, we're always looking at the series of trades. It's never about any individual trade. The profitability comes over the series of trades, but in order for that to work, we have to manage each individual trade appropriately. It also, in terms of the trading process, it allows us a technical location on the chart where you can base your risk off in any trade, and the importance of that is, for your position sizing and for your filtering of your trades. If your strategy has tested well at 1 to 2, for example, in order to work out if you're meeting that 1 to 2 risk reward, you need to know where to take your risk off. So you need to know the location you're going to put your stop and the location you're going to look to get in, be that your average entry for a scaled entry or your single price point location. And that allows you your risk. It allows you to calculate your 1R for risk, and that then allows you to look at where your profit targets are going to be and allow you to calculate what your risk to reward ratio is within that trade. And as I said, it's a tool that allows you to filter potential trades based on that risk to reward calculation. So if within your back testing, for example, that your strategy is only profitable if you can hit 2 to 1 risk reward, then you can filter out anything that's lower than that based on your stop loss location, your entry, and your potential T1. So it provides you that kind of filter for taking out trades that if you took, you wouldn't be profitable across a series of trades. So that's kind of the high level of what a stop loss is and how you should think about a stop loss. It's your insurance against unexpected losses within trades, and the way that we make sure that we are being consistent with how we're applying risk across a series of trades, and enables us to protect capital in both the individual trade but consistently across that series of trades. Let's get into the meat of the session then, and start looking at how you identify where a stop should go. And this is something that when I speak to people, I think it's far too easy to become overcomplicated, so we need to try and make it as simple as possible. And the best way, I think, to think about a stop loss location is really as simple as asking yourself, where on the chart, technically, is my idea wrong? That's where the stop loss should go. And when I say where is the idea wrong, that's obviously based on your back-tested strategies. It's not kind of looking at a chart and just arbitrarily thinking I'm going to take a trade here based on nothing. As we've covered in the previous sessions, your strategy should very much be rules-based and tested before you're even looking at a chart to trade them with live capital. And that testing process should give you a good idea as to where the stops should go optimally within that system. So we'll have a look at an example in a second. But I think one of the things that's key to pull out on this is that they'll be different for every trade in terms of the level and the percentage within that trade. And I mentioned in the numbers video that there are two separate risks that we need to manage. There's the individual trade risk, and then there's the account capital risk that trade presents. When we talk about, or when I talk about, 2% maximum account loss per trade, as we discussed in the previous session on the risk management plan, that doesn't mean you come into every trade and just go in with your full account and pick an arbitrary 2% stop, because you're going to get stopped out more often than not if you take that approach. Your trade risk could be far higher if it's on a longer term chart, like a 4 hour or a daily or a weekly, or far lower if you're looking at intraday levels or scalping type trades, than your 2% or your max account risk per trade. And we then use position sizing to make that individual trade risk the account risk, and that's something we'll cover in the position sizing session. It is far simpler than it sounds, but the key message in here is that the stop location will be different for every trade. It's not going to be the same 2% trade risk in every single chart. It's going to be based on the technicals of that chart, and that could be on a scalp 0.08%, or on an intraday trade 0.5%, or on a swing trade it could be 6 or 7%. So it just depends on the individual trade. And the trick to the consistent loss is using position sizing, as we'll talk about in a later session, to make that trade risk a consistent account risk. So if we look at this example then, now this is a trade that I took earlier this week. I'm not going to go into the strategy details and why I took this trade. We're just looking at the stop loss. So for those not familiar with TradingView, the green box at the bottom is my entry to profit target, and the grey box at the top is entry to stop. So in this scenario, for me, it was really as simple as the 4 highs you can see on the left hand side there, or actually there's 5 if you look further to the left. If price went above those highs, that's where my idea was invalid. That's where the strategy was invalid. If it broke above those highs, then I was wrong. So obviously if I'm wrong, I want to get out as quickly as possible because I don't want the trade running too far against me. So that's where my stop location goes. My entry location is based on my entry criteria there, and that gave me a roughly 5 to 1 target on this one. Now that's a 5 to 1 overall for the trade. My first target here was those initial lows that you can see at the bottom, so that was around about a 3 to 1 risk to reward. And that's really it in terms of how you place the stop. You shouldn't really make it any more complicated than that. You should be looking at your charts and saying, this is my trade strategy. Here's an idea of where I think this chart is setting up to meet all the rules of my trade strategy. Where on this chart am I wrong about my rules being met, and this going to go in my favour? That's where the stop loss goes. So hopefully that as an example kind of shows how easy you can make stop placement. It should be fairly apparent by now then, based on the chat so far, how stop losses fit into your risk management plan and how they're your application within each individual trade of that risk plan essentially. But they are, along with position sizing, how you apply your max account risk per trade on a per trade basis. So as we've discussed there in that example, if you're targeting, for example, 2% as a max account risk. Your stop loss then defines your individual trade risk. This is mostly always going to be different to that account percentage in every individual trade, because they are individual to that trade. Identifying that trade risk via your stop loss location and your entry allows you to apply position size maths, and that position size maths is what makes your trade risk equal your max account risk in every trade. So that's what then keeps you consistent, and it again makes sure that at an account level those losses that you suffer, they remain in that expected category, as opposed to the unexpected losses if price runs away from you. So that's how the stop loss kind of fits back to your risk management plan, and how your risk management plan is applied within individual trades. And we'll cover more of that again in the position sizing session, and it'll make more sense when we see that. But I just wanted to make sure we tied the actual stop itself back to that risk management plan as part of these sessions. Let's have a quick look then at some common stop loss mistakes that you should look to avoid. And the first of those should be fairly obvious, and that's not using a stop loss. I think it's probably fairly apparent based on the session so far in this session that I'm a firm believer that in any trade you should be using a stop loss. It is the way that we protect our capital, and it's one of the few tools that we actually have for ensuring that capital remains as protected as possible while we put it at risk. I know there are plenty of people who will disagree with that, and there are plenty of people who don't use stop losses, but it's certainly not something that I could ever do personally. I think it's as simple as, if you trade in highly volatile markets, and let's take cryptocurrency as an example. We've all seen, even just this year, examples of prices almost going to zero in the matter of a day or a few hours. And if we look at things like FTX and Luna, now, granted these are specific events that are not necessarily market driven, but still that volatility exists within the market because it's so new and because it is highly unregulated. So it's something we really need to protect for if we're trading in that sort of market. But even then, I mean, there are traditional markets you can find examples of prices moving in excess of 10, 11, 12% on a daily basis. We've seen large moves in currency and currency indexes within currencies themselves. We see large moves on stock indexes. It's not a scenario that we're protecting against where something dies and goes to zero. We're just protecting against excessive loss, and that's really how you should look at it. It's that expected versus unexpected loss. And if you look back at the numbers within the first session, when we looked at how much or how hard it is to recover from excessive losses, and how much of an account you would lose after a series of excessive losses, it can wipe you out really, really quickly. And if you consider, let's say for example you've got 5 trades on at the same time, and something happens market wide, there's a news event that happens market wide, and you're not using a stop loss, and all 5 of those trades lose 10%, and you're in with your full account across those 5 trades. That's 50% of your account you've lost within those trades, because you've got 5 risk bearing trades all losing 10% at the same time on 100% of your account capital. It just doesn't make any sense to take that risk, in my opinion. The next one on this list then, and we covered it in the last slide, so we'll not go over it too much, is using an arbitrary percentage stop in every trade. So if you're going into every trade and saying I'm going to put my stop at 2% or 3% or 4% or whatever it is in every single trade, you're going to get stopped out more often than not if that stop is too tight. And in order not to get stopped out so often, you really need to have that stop so wide that it almost doesn't function in terms of the stop and protecting your account in the way that it's supposed to anyway. So as I said, the arbitrary percent really comes from your risk management plan, and that's at an account level. But the individual trade risk or the trade stop is going to be whatever that trade dictates, and the trick to consistency is making them equal each other using position size and so on. Again, we'll cover that in a future session, but the point here is you try not to use arbitrary stops in every trade. It sounds convenient if you say I'm going to use 2% all the time, but charts and markets don't work that way, particularly if you're trading across different asset classes. They all behave in different ways, and even within the same asset classes, charts and assets will behave in different ways. They all have their own kind of personality, and it takes a while to get used to that personality and figure out what is the most likely within any given chart. Again, that's part of the backtesting process and just getting to know the assets that you're going to trade. The next one then is removing your stop altogether, and this is something that's more common than you would think. I've referenced previously the studies that we've done on retail trading data, and how we as retail traders are far more likely to add to a losing position and hold a losing position as it gets worse than we are to add to a winning position or hold a profit as it gets better. And that's a psychology angle of it. There's a fear angle to it, where when we're in profit, we want to take that profit and crystallise it as quickly as possible because we want to make sure that we don't lose the profit. And when we're in loss, we don't want to take that loss and we don't want to crystallise it because that means actually taking a loss. And we're very good at convincing ourselves that, you know, if we just hold it for a bit longer, it will come back. Or if I just add more to this losing position, I need to make less for it to break even. And the reality is that is what wipes people out. That's what gets people wrecked in terms of managing their trades. And removing the stop is part of that. You really need to be comfortable with the idea that you are going to be wrong. You need to be okay being wrong, and you need to understand that your stop is your protection against being wrong. That's your insurance against being wrong. You know, in every trade, if you're applying your stop consistently, you're going to lose this much, and that's fine because you'll get more than that back in your next winner. So removing the stops is a huge no-no for me, and it's not something I would ever recommend you doing, because you're essentially cheating your system at that point. You're cheating your rules, you're cheating your testing, and it's not at your advantage, it's to your detriment over the series of trades. And similar to that, moving your stop wider. So when I talk about moving stops in the next slide, a lot of people think it's okay then to move your stop wider, but that's never the case in my opinion. Again, if you look at that logic, you've got an idea, you've tested it, you've got your rules, your stop tells you where you're wrong, so you want to make sure that's where you're getting out so that it's not running away and causing you any unexpected loss. Your losses remain expected. If you decide when you're in the trade, it's going to turn around at some point and go in my favour, I'll double my stop, I'll move my stop out, I'll move it to twice what it was or 3 times what it was. You're just then taking a bigger risk with your account, because if you've done your position sizing properly, then your max account risk per trade is what you're going to be in at your stop loss at. And if you double the width of your stop, then you've doubled your risk there. And if you quadruple it, you know, you're quadrupling your risk, and it just becomes a slippery slope when you start moving your stops wider to try and convince yourself that it's going to turn around and go for you. And your back testing, again, will tell you that's not the case. That's why you do the back testing, because you know that's when you're wrong, and that's when you should get out and you take that capital and you look for your next setup and you get in following the rules again. It's just cheating the system and trying to lure you into a false insecurity. It might work once or twice, but again, over the series of trades, which is what matters, it's not going to be a profitable strategy for you to move your stops wider consistently. Have your stops, have the reason for your stops. That's where your idea is invalid, that's where your rules have broken. Get out, move on to the next trade. Remember, it's not about that individual trade. You don't need to be concerned with winning or losing the individual trade. It's about the series of trades. And the last one I want to talk about in here, and we'll cover this in a wee bit more detail when I do the leverage session and the responsible use of leverage. This is something that's specifically aimed at leverage traders or futures traders, and that's relying on liquidation price as your stop loss. In my early days of margin or leverage trading, I was involved with a few groups, and we would talk a lot about liquidation prices and don't need to worry because the liquidation price is here or it's this far away or whatever. And that is a very dangerous method of providing risk or doing risk management. It's not risk management at all, realistically. The leverage casinos are built in a way that the odds are always going to be in their favour, essentially. They are casinos, and that's how you need to think about them. Your stop loss should be well before your liquidation price, and in my opinion, if you're doing your position sizing properly and you're doing your risk management properly, you never have to look at your liquidation price when you're taking margin or leverage trades, because your stop is always so far before that it doesn't really matter. It becomes an irrelevance. And if you are relying on your liquidation price, you need to remember that liquidation price covers your entire account. So that's liquidating your entire account as a a method of making sure you can afford to pay back the leverage that you've got in that trade. So you're essentially taking 100% risk on every individual trade when you rely on your liquidation price. Now, granted, there are different types of liquidation. You may be using isolated margin rather than cross, but cross is the more common. And I certainly know of people who have lost their entire account, 6 figures overnight, because they were reliant on a liquidation price rather than placing a stop loss and being willing to take a small, 2% account loss on a trade. They wanted to leave that in to try and get more on the other end of it, and ended up losing the entire account from there. So liquidation prices, again, this is just my view on leverage. Liquidation prices should be an irrelevance, and they should be made an irrelevance by your stop losses and by your risk management plan. So it's just one of those kind of things to bring up. Well, when is it okay then to move your stop loss? And there are occasions where it is perfectly reasonable and actually encouraged to move your stop loss, and that's when you're moving it forward or moving it up to protect either your initial capital or your profit that you've already got secured in the trade. So we only ever move stops tighter, never wider. So they should always go towards or beyond your entry position rather than further away from your entry position. And there are a few occasions where, for example, I like to move my stop up, and you'd have to think about these yourself in terms of how you might want to use it and back test it for how you would utilise it within your own strategies. But for me, for example, after I've taken partial one within a trade, I like to move the stop up either to the entry price to break even, or just above it, depending on how far T1 was ahead of the entry price, to protect some of the remaining capital that's within that, or some of the remaining trade that's left. So just as a kind of easy example, that previous 1 to 3 trade that I said earlier, that I had in there, given that was a 1 to 3 at T1, when that reached T1, I took the first partial. It was already kind of far enough away that the next high was almost at 1 hour again. So rather than move it to break even, at that point you look at it and say, well, where does this trade become invalid now? The stop loss is where I defined the trade was invalid when I went into entry. Given that price has moved on so far from entry, where would price have to come back to in order for it to be invalid now? So you can almost look at it as if you're placing a new trade once you've taken your first partial. And if you were going to put a second position in now where price currently is, where would you put the stop loss then? And if that goes above a high that's beyond your entry price, you can move your stop to there if you so choose, in order to protect another small amount of profit while you leave the remainder in to run for your partial 2 and partial 3 or whatever it is you've got planned in that trade. So there are occasions when you do that where it'll come back and wick you out because you've moved it up too far, and it'll head on in your favour anyway, and you're out to trade at that point in time. So you need to be careful with that in terms of trailing the stop. But it's something to play around with and something to look at in terms of how you'll do that within the trades, and it's something that should be in your risk management plan, like we spoke about last week. So the second way that you would move it up, and I mentioned it there, it's just if you're trailing the stop. So let's say you've decided you're going to take 80% of partial one, but you're going to leave 20% in and just trail the stop up to try and get as much as you possibly can in that regard. So every time it makes a new low in that scenario, because it was a short we looked at earlier in the example, every time it makes a new low and then sets a lower high and then makes a new low, you might want to kind of move your stop up to be tracking those lower highs, and that's where you're securing more profit in there. You may want to move it up when you're in a trade and your trade's moved into profit, but you don't have time to manage the chart or manage the trade that day. Life sometimes gets in the way of all of us. You have to go somewhere and do something, and you don't want to leave the trade unmanaged. So rather than leave it with your 2% stop in, you're already in profit. You may move that to break even at that point in time, so that you're not going to lose. You've de-risked the trade entirely before you're away from the chart, and if it does then stop you out at that point, you've not lost any money. You've moved it up to break even and enough to cover your fees, for example. Another one that I would use in terms of stops is if I'm in a winning position, but it's later on in the session. So let's say it's something I've taken in the New York afternoon session, and it's still running overnight, or there's a portion of it still running overnight, and I'm about to go to bed and I don't have time to manage it because I need to sleep. We all need to sleep. You you might want to move your stop up in that scenario, either to break even if you've not taken a partial yet. On that, I would generally always recommend taking a partial if you can before you go to sleep and moving the stop up, but it depends on what works for you. You may want to then move your stop up to break even or into profit before you go to sleep, so that if it does come back on you overnight, which can quite often happen, particularly in the Asian session, you've not taken a loss at that point. Or another example would be if you're in a trade running into a high impact news day. So let's say you've had a trade the day before the CPI or the FOMC meeting. You're still in that trade, or you're still in a portion of that trade. You expect volatility around about the news events at the start of the US session at 8:30, or depending on when FOMC is, potentially in the afternoon session. So you would look to secure your trade. Again, taking partials at those kind of scenarios is good practice, but at the very least move your stop so that you're not going to get wiped out if you're in a good position within the trade. So there's a few examples of when you might move your stop to try and protect your trade and essentially manage the trade once it's in flight. We'll cover a wee bit more about that in the in-flight management session that we're going to do. But those are just a few examples for you to think about, and there may be others that you would want to look at. But it's just the point really is you use the stops to move, or you move the stops into profit or to break even in order to protect the position, rather than move them wider because you think it's going to turn in your favour. That was one of the mistakes we spoke about in the last session. So that's very much it for this session on stop losses. Hopefully that all makes sense. Next time we'll pick up on position sizing and tie it all together. Until next time, stay safe. My tea's it. Got to go.